We are even more important today than we were before the weekend.
Now, you heard, of course, Megan mention the concerns in the region about Iran targeting oil facilities.
There's a really interesting thing developing around the Straits of Hormuz are this choke point in the Persian Gulf. 20% of the world's oil passes through there. And right now you've got ships essentially parked on either side of the strait. The ones trying to leave saying, I'm not going to go through there just yet. One tanker was hit and was set on fire. That set off a lot of concerns. A lot of insurance companies have said, we're not going to insure you if you go through the Strait of Hormuz because of the obvious concerns. Oil markets, oil-using countries are all looking at this and still trying to figure out what this really is.
For over a century, 96% of Canada's oil exports went to the United States. One buyer, one market, one massive vulnerability. But something fundamental just shifted. And the timing with Middle Eastern oil choke points shutting down and global energy markets in chaos means Canada is positioning itself as the secure alternative supplier the world desperately needs. Except this time, the oil is not flowing to America. Alberta Premier Danielle Smith says the war in Iran underscores the need for a new pipeline connecting her province's oil reserves to the West Coast. She made the comments Monday at an unrelated news conference in Lethbridge. Smith says any disruption in the Strait of Hormuz, a key oil choke point at the mouth of the Persian Gulf, only underscores the need for a new pipeline that could bring her province's pivotal export to Pacific shipping lanes. Here's what is actually happening on the ground. Prime Minister Mark Carney and Alberta Premier Danielle Smith support a new Indigenous co-owned pipeline to the Pacific. After years of antagonism between the federal government and Alberta over additional outlets for crude Canada and the oil-producing province are finally on the same page. It took a major geopolitical and trade shift from Canada's long-term ally and top trade partner, the United States, to make this happen. The pipeline is expected to boost Canadian oil exports to Asia, the world's driver of global oil demand growth, by shipping about 1 million barrels per day of crude from Alberta to the West Coast. That is not a small expansion. That is an entirely new export corridor designed to fundamentally reshape where Canadian oil goes. Acting as proponent in the initial stages, Alberta's government is drawing on more than a century of technical expertise to deliver a submission to the Major Projects Office by July 1st, 2026. That is 4 months away. The clock is ticking. Provisionally named West Coast Oil Pipeline, the project is now in the stage in which a technical advisory group is doing preliminary assessment work on the potential routes. Why now? Because the old model is broken. Canada is the world's 4th largest crude oil producer, with an output capacity of 5.76 million barrels per day. But 96% of exports went to the United States. That concentration created leverage imbalances Canada could no longer tolerate, especially after the rise of US tariffs. According to Prime Minister Mark Carney, more than 75% of Canadian exports went to the United States in 2024, and this tight interdependence has become a weakness. So Canada started building alternatives. The Trans Mountain Expansion Project came online in May 2024. Since the expanded pipeline began operating, Alberta's oil exports to Asia have surged from zero to over $804 million US dollars, which is about 1.1 billion Canadian dollars as of October 2025, but Trans Mountain is just the beginning. Just over 3/4 of the 375,000 barrels per day of Canadian heavy crude exports from Vancouver were destined to Asia Pacific year to date, November 2025, according to data from analytics, firms Vortexa and Kepler. And demand is growing. Chinese interest in heavy crude is expected to grow next year as refineries bring online increasingly advanced cracking units to improve petrochemical yields. Here is the strategic advantage Canada offers Asia. For China, Canada alleviates its Malacca dilemma, in which 80% of its oil imports from the Middle East must transit the Strait of Malacca. North Pacific shipments are faster and more cost-effective than those through the Malacca Strait or the Strait of Hormuz. With the Strait of Hormuz now effectively closed due to conflict, that advantage just became critical. The new pipeline proposal is designed to capitalize on this moment. If advanced, the project will significantly increase market access to Asian markets hungry for Alberta oil products and reduce dependence on US markets. Indigenous communities are central to the project. From the onset, Indigenous communities are providing leadership, guidance, and stewardship that will help shape the project every step of the way. The politics behind this are extraordinary. Prime Minister Mark Carney and Alberta Premier Danielle Smith reached a political agreement to work toward the possibility of a new oil pipeline that would be constructed from Alberta to the British Columbia coast. Specifically, they signed a memorandum of understanding that outlined cooperation on energy development goals and changes in climate policy. Late last year, Smith signed an agreement with Prime Minister Mark Carney that paved the way for a potential Indigenous co-owned pipeline and the clawback of environmental policies standing in the way. The deal aims for Alberta and Ottawa to agree on an industrial carbon price by April 1st, 2026, and sets a July 1st deadline for a pipeline proposal to be submitted to Ottawa's Major Projects Office. There are trade-offs. By April 1st, 2026, Alberta is to sign an agreement to mandate a 75% cut in methane emissions by 2035 in comparison to 2014 levels. Furthermore, Alberta agrees to cooperate with federal policies on carbon pricing and large-scale carbon capture projects as a means of addressing the climate impacts that would arise from building new fossil fuel infrastructure. Environmental groups are pushing back. Keith Stewart at Greenpeace Canada said in a statement to the Canadian press that war might provide windfall profits for oil companies and exporters in the short term. But we would be fools to ignore how oil and gas importers are accelerating investments in domestic wind and solar power, so they are not held hostage to the brutal geopolitics of fossil fuel dependence. But proponents argue the strategic case is overwhelming. Danielle Smith said, if the uncertainty continues, it only demonstrates that the world and Canada's trading partners need to have a stable source of supply. She added that everyone hopes the conflict ends quickly with minimal loss of life, and that Canada is watching closely to understand what its friends and allies are going to need. The economic stakes are massive. The conflict could also affect Danielle Smith's political fortunes, because the price of oil tends to make or break Alberta's budget. Last week, Smith's government projected a $9.4 billion deficit for the coming year, based predominantly on sluggish oil prices. Depending on how much market volatility is still to come, with 1 month left in the province's current fiscal year, Smith said what was expected to be a $4.1 billion deficit might be somewhat less than that. Higher oil prices driven by Middle East conflict could dramatically improve Alberta's fiscal position while simultaneously strengthening the economic case for the new pipeline. But there is a capacity constraint looming. ATB Economics notes that maximizing the capacity of the current pipeline system will support further production increases in 2026, with oil and gas exports projected to rise by about 2% in both 2026 and 2027. However, analysts warn that without additional pipeline infrastructure capacity, constraints could limit output growth as early as 2028. Prime Minister Mark Carney has been positioning Canada globally for this moment. Mark Carney visited China last month and signed a strategic energy and trade cooperation agreement in a major policy shift that hailed a new era in bilateral relations. That was not symbolic. That was commercial groundwork for redirecting Canadian oil exports from the United States to Asia. The broader pattern is clear. Canada is diversifying. Energy to India, liquefied natural gas to Japan and South Korea, defense partnerships with Australia, critical minerals agreements across the Indo-Pacific, and now oil to Asia through a new Pacific pipeline designed to carry 1 million barrels per day to markets that are not American. For over a century, 96% of Canadian oil went south. By 2028, if this pipeline gets built, that percentage could drop dramatically. Not because Canada stopped producing, because Canada found other buyers. And those buyers are desperate for supply that does not depend on Middle Eastern choke points that keep shutting down. The United States assumed Canadian oil would always flow south because there was nowhere else for it to go. Canada is proving that assumption wrong, one pipeline at a time.